Very good morning to all. Very warm welcome on behalf of Team CogNext and SoftFlex. My name is Kedar Patkar, and I lead business in ASEAN region for CogNext. This is the second webinar we are organizing in partnership with our local partner SoftFlex, specifically for Cambodia region. There are few our local customers are also joining from other regions too, but this is specifically organized in partnership with SoftFlex for Cambodia. The topic of this webinar is on asset liability management and related reporting. The webinar would be hosted by my colleague, Mr. Satya Vemireddy. Satya brings in more than a decade experience as a practicing consultant and ex-banker. He also has put in thoughts and experience to devise a solution for asset liability management and regulatory compliances. This topic we consider utmost important for upcoming geographies, both in terms of regulatory compliance and as well as for internal needs of management reporting. With this quick introduction, let me also bring in Mr. James from SoftFlex. He has also joined as a panelist, and James will summarize the discussions toward the end. For now, let me hand it over to Satya and kickstart the webinar. This is going to be a 45 minutes discussion, and last 10 minutes we will utilize for question and answers. You can put in question and answers in a window.
I think Mr. Kedar, you can proceed further because I will quick introduction from SoftFlex side after we finish the webinar. Okay?
Yeah, sure.
Thank you, Kedar. Thank you.
Over to you, Satya.
Thanks, Kedar. Good morning, everyone. This is Satya Vemireddy. I lead the balance sheet analytics and advisory practice at Aptiva and CogNext. I've been in this space for more than 15 years now. And as the topic suggests, today we are going to look at asset liability management and best practices in light of the recent changes in the market environment due to various events that have impacted the global economy. So let me quickly share with you the screen. I hope the presentation is visible on the screen to everyone. In terms of the agenda, as I just mentioned, because of COVID-19 and a number of other changes, in the market as a result in terms of changes in interest rate, levels that are being regulated by various central banks, and also the reaction of the market, changes in behavioral profiles of customers, it has become very important for banks to relook at ALM and essentially to emphasize the core aspects of ALM as such in terms of the risk measurement, the methodologies, and the monitoring process to accurately capture risks on their balance sheet and take appropriate actions. So to cover these issues, so we have structured this presentation in the following 5 key areas. First, I'd like to touch briefly on how ALM still plays a very strategic role in the management of the balance sheet at banks and financial institutions, and starting with the highest level of management committee that looks after asset liability management, that is the asset liability committee, which is ALCO, and what should be the mandate of ALCO, and what kind of questions do ALCO need to look at in these times, and what kind of analysis should they be driving. So that is one aspect that we'll be looking at. And then next we'll be looking at certain leading practices in terms of setting up ALM policy and the operating model that is required to drive an effective ALM policy. And then we'll look at how key risks like liquidity risk and related funding risk, interest rate risk in the banking book, and driving from there fund transfer pricing, how these specific functions have been impacted because of various changes in the market and the operating environment. And finally, we also like to bring forward an idea that we have been advocating in various markets as being an integrated and analytical approach to ALM rather than a reporting, simply a reporting approach to ALM. So with that, let me start with the the strategic and management aspects of ALM. The first aspect in terms of where the ALM function fits in with the bank, if we start from that point, essentially the role of banks in the economy is financial intermediation, and there are two important areas that relate to financial intermediation that banks play their roles within the market. One being credit underwriting, and the second being maturity transformation. These two areas are the key profit centers of any financial institution. By underwriting credit, that means taking on the credit risk and earning the credit margins. And the second is maturity transformation, where they can borrow short and lend long, thereby transforming from short to long maturities, and thereby earning what is called the ALM spread or the funding spreads. Now, the credit side of the business has always been heavily regulated because that's usually what is understood as 80% of the risks faced by any financial institution. But a similarly important but most often overlooked area is maturity transformation, which is also very key in not just the profitability of the bank, but the survival of financial institutions themselves. So on the credit side, there have been number of regulations historically in terms of the standardized approach for capital requirements for credit risk in the form of the Basel II regulation, and then certain standardizations that they were brought in terms of the Basel III and the advanced approaches, the internal ratings based approach in the fundamental on the credit risk. And then the ICAP, the process where the internal capital adequacy is being assessed, and again this has also been adopted by the number of regulators in a number of jurisdictions. And an important aspect of ICAP is usually the credit stress testing aspect. And then more recently, most financial institutions across the world are moving towards a standard set of expected credit loss models in the form of IFRS 9, and then all the related models, and then the requirement for regular model validation. Now, this kind of rigor and tight regulations have historically not been applied on the maturity transformation aspect of banks. But since the global financial crisis, regulators have seen how maturity transformation as a function can impact not just the profitability but the survivability of financial institutions. So hence, from then on, we have seen a number of new regulations in this space as well. Starting with the Basel III liquidity, the tools and revised methodologies for monitoring and managing liquidity within the banks, which key ratios like LCR and NSFR. And essentially where banks are required to monitor certain key ratios in terms of the short-term liquidity within 30 days and long-term funding profile, typically over 1 year horizon as part of NSFR. And the second aspect has been interest rate risk on banking book, which is another key risk in the maturity transformation process. And again, there have been the BCBS 368 has been launched a couple of years back. And many regulators are adopting this. A number of advanced economies have already adopted this. And post the Pillar 1 methodologies in liquidity, which are essentially LCR and SFR. Now regulators have started to bring in the pillar 2 approach, because what they have realized is, in as far as maturity transformation is concerned, there is very little applicability of pillar 1 approaches, because the risk is not straightforward like credit underwriting. So a number of aspects of balance sheet need to be looked at simultaneously, namely stress testing and pricing and various other related aspects of the balance sheet. And therefore, rather than assign capital in lieu of residual risks in these spaces, Basel has or BCBS have been recommending to adopt a complete liquidity adequacy assessment program on the lines of ICAP. And a number of regulators, both in Europe, US, GCC, and even in Southeast Asia and Africa, have been launching the ILAP regulation, which is another key aspect of maturity transformation. And we'll be looking into some of these aspects, during the overall presentation. And one, important point that derives from these new regulations, either it be interest rate risk in banking book or internal liquidity adequacy assessment plans. One key aspect is that these are analytical models. So these are not simple, ratio computations or static computations. These are essentially simulations. And a number of behavioral assumptions go into these models, and then therefore require expert judgment, or at least oversight of senior management and expertise in these areas to build these models. So and as I mentioned, so one is the regulatory aspect, which is now starting to look at these areas. So as we highlighted, it is more moving towards a simulation or a scenario-driven approach rather than a static approach, or the pillar 1 approach, which has been pre-COVID. And the main reason is central banks or regulators are not just looking at accurately measuring the risk, but they want to ensure that financial institutions are resilient to any future shocks. And historical or look back metrics, or simple stock ratios, they may help in looking at the current structure and the current risks on the balance sheet, but they would not be able to tell the regulators whether these financial institutions that are being regulated are healthy enough that they'll be able to withhold future shocks. And that's where the dynamic approaches come in. And this is the direction that all the regulators are moving in. And resilience is the key operating word in this new approach. And then that brings us to what it is that essentially at the core of all these things, what it is that financial institutions are trying to look at. What is the core concern of the senior management of banks, or the board, or the shareholders? It essentially is to ensure that they are able to maintain their growth levels, they are able to maintain their risk, levels of risk on the balance sheet. They are also able to maintain the profitability levels as the world moves more towards digital and offline, online forms of banking rather than traditional forms of banking. But a few challenges that have been faced by banks so far are because of the volatility in the markets. There is increased riskiness on the balance sheet. So that's one main concern. And there's also been regulatory tightening. As I mentioned, a number of new regulations have come in, and regulators are wanting banks to submit more frequently and at more granular levels. and they also want to bring in more simulation-based measurement rather than stock-based measurement. So that's another big challenge in terms of building up the capability to meet those regulations. And the third aspect is a fundamental shift in the customer behavior. So this is an important aspect because the last couple of years that have been banks witnessed a significant shift in the behavior of customers. The kind of products customers are looking for, the kind of interactions that customers are having with financial institutions, and the increased competition, because this change in customer behavior has led to a significant decrease in what is called strategic advantage enjoyed by classical financial institutions, in that the threshold for entry into the market has been reduced significantly for a number of banks. So you see a new category of financial institutions forming now called digital banks, and these digital banks are using pure online approaches to reach customer and develop the relationship and offer them products. And so this is a fundamental shift in customers, and these key areas need to be considered when developing the future strategy of the existing banks. And when we mean future strategy, so that entails these four key areas. The first one is the direction. So what is the direction that the bank wants to go from this point on? What are the key value propositions that the bank wants to present to its customers? How does it wants to position itself? Does it wants to position itself as a digital bank or a conventional bank, or catering to a specific segment of customers who are more digitally savvy? And which sectors, because the impact over the last couple of years has not been even on all across sectors. Some sectors have continue to witness large scale growth, while many sectors have slowed down. So this also needs revisiting. And the structure of the products themselves. There is now more higher demand, for example, mortgage segment, because more customers are looking to invest in homes, because now work from home has become a reality. So these are a number of areas that, in terms of direction, that banks need to look at. And these are typically decisions, taken in at the board level. And then we look at the growth aspect, which essentially is what kind of growth. So once you decide the direction, so what is the level of growth that you can achieve realistically, given your own capabilities and the market share that you currently enjoy, and the scope for additional growth in across these various segmentation sectors, products, so on and so forth. So this is where people with keen understanding of the market will be able to bring in that kind of projections in terms of what growth is possible, and then to support it in terms of ALM function, what kind of funding profile would be required, and what kind of growth in the funding would be required going forward to support that kind of direction. And then deriving from them and these decisions, the growth related decisions, are more analytical in nature, and this is where business units provide their input, and executive committees that do the analysis decide on the level of growth. And the third aspect is the efficiency. This is largely operational. We'll not be touching on this, but this is essentially what I've been talking about in terms of how banks need to become more digitally savvy to reduce their costs, and in approaching and adopting new channels of sales where they can quickly and easily approach customers. And these are largely driven by the COO office and the support functions. And then finally, the health. Health essentially is that there is strong governance and oversight on the risk-taking process, and all the target risk metrics like average portfolio credit ratings or liquidity levels, capital levels are all maintained at all points in time, taking into account the direction and the growth that has been planned. And this is where ALCO comes in very prominently in terms of being able to understand the direction that the board level wants to take, and then also look at the growth levels that are needed, and then take them and simulate the balance sheet to see whether the direction and the growth levels are consistent with the key risk metrics that as per the risk appetite that the bank wants to maintain. So each and every aspect of strategy formation has basically undergone fundamental changes because of the last couple of changes in the last couple of years, and this necessitates full refresh of strategy under the new environment. And this brings us to what role that management can play in this process, and specifically, we are going to look from the perspective of ALCO. We are not really interested in looking at the executive committee or looking at the risk, risk committees, or the credit risk committees, which are looking at the credit aspects. We are going to focus on the ALM aspect and therefore the ALCO perspective. So in terms of ALCO, there are three key questions that need answering, and in subsequent slides we'll also look at typically what needs to be the mandate of ALCO, what all functions need to be monitored by them. But at the highest level, these three are the key questions that ALCO needs to address. First, in terms of risk, because primarily they are a risk committee, or at least look largely on the risk management aspect. How can the bank ensure that all material risks on the balance sheet are measured and monitored accurately? And if the bank is prepared for unforeseen events. So this is the key question, not just ALCO is asking, but this question directly derives from what the regulators themselves are asking across the world. And the second then question comes the strategic planning, which we talked about in the earlier slide. Now, given this change in market scenario, how do I protect my net interest margin? And how do I ensure that the planned growth is realistic and achievable within the risk appetite? This is exactly what we just talked, in the earlier slide. That purely from an ALCO perspective, all they're looking at is, NIM is one of the primary, outputs that they monitor, net interest margin or net interest income, and they need to also, look at what kind of growth is being planned and ensure that the funding structure is able to support that growth. And also at the same time ensure that all the risk parameters like LCR, NSFR, and all measures used in interest rate risk and FX risk or funding risk and off-balance sheet risk. So all these are still within the defined risk appetite limits. And the third aspect is which is the core concern of the ALM function as such, which is funding and capital management. So and given this revised strategy, so what is the right level of liquidity and funding, and whether the capital that is currently available, is it sufficient to meet the growth, or whether there is need to issue new capital instruments in the market, and whether this profile and this liquidity level, will it be able to sustain if there is a new contingency, whether in the form of a new sudden lockdown or a new shock. Now, and then we'll now in detail look what are the sub-elements of each of these areas. And when we say ALM best practices, we need to link. So best practices are always linked to the environment in which we are operating. So what are the most suitable actions that banks need to consider given the current scenario, and also in the sophistication levels that are used by the banks. So this is a bit more detailed look at the mandate of ALCO, what needs to be the mandate of ALCO. So here we highlight the key areas that ALCO typically needs to look at, starting with capital management, liquidity risk management, interest rate risk management, and within that probably FX risk, which structural FX risk. And then a key area now, a new area which ALCO needs to start looking at is rapid scenario analysis, what if scenario analysis, given the dynamic nature in the market, and then prepare various contingency plans based on those scenarios. So historically, stress testing and contingency funding plans have always been part of ALCO mandate, but there is now a renewed importance given in this area because earlier that exercise used to be a quarterly basis, semi-annual basis, but not a frequent activity. Now it needs to become very frequent, and and it should not just look at only the liquidity aspect or only the interest rate risk aspect in silos. It should be able to look at an integrated view of the entire balance sheet under a given scenario. So that's the key addition. In terms of the key specific areas, governance and risk framework, setting up the ALM policy, the liquidity risk policy, interest rate risk policy, FX policy, structural FX policy, defining the key roles, and then setting the risk appetite. Risk appetite in terms of both normal limits and stress limits across all key risk measures. So what kind of measures need to go into risk appetite, that we'll look at in subsequent slides. And liquidity risk and funding aspects, review and approve the liquidity risk policy, stress testing framework, contingency funding plans, regularly monitor liquidity gaps, ratios, and funding concentration levels. And on the interest rate risk side, they need to look at and review and approve, again, the interest rate risk policy and methodologies and the overall governance framework. If there are certain internal models that they need to have clear oversight in terms of the assumptions that go into the kind of data and the quality of data and the assumptions that go into these internal models, and how these internal models are used, and are they consistent with the other frameworks in the bank, like for example the Pillar 2 approach under ICAP, does it fall in line with the models that are used for interest rate risk measurement as part of the IRRBB, so on and so forth. And in terms of market risk, it's largely looking at the FX risk on structural FX risk or any other corresponding risks that are on the banking book, and monitoring and of course any derivative positions derived from the hedging activities, balance sheet hedging activities in terms of interest rate risk, and looking at the impact of them on earnings and capital, and providing approvals for hedging strategies. And then we further move on to business performance. So this is where fund transfer pricing plays a key role, and ALCO also plays a key role in terms of reviewing the segment profitability statements, and how various products both on the asset side and liability side are being priced, how liquidity uses and sources of liquidity are being priced, and whether the methodologies used within FTP are in line with the liquidity risk and interest rate risk methodologies used. And then deriving from that, ensuring that the products offered by the bank are priced adequately to reflect the current levels of interest in the market, and also comparing with the competition in terms of benchmarking. And then in terms of capital management, look at the current levels of capital ratios, and approve plans to issue new capital instruments, review the ICAP and RAROC methodologies, and set tolerance levels for capital stress testing and how capital capital ratios can get impacted because of ALM risk like liquidity and interest rate risk. And then all of these go into then deriving a deep insight into the balance sheet, the nature of the balance sheet, in terms of various risks and in terms of the pricing and in terms of these capital levels, and then tweaking and reviewing the direction that needs to be taken by the bank in terms of the types of funding, what tenors the bank can issue, and whether they can continue to issue fixed rate loans or they need to shift to repricing loans given how the interest rate environment is changing. So all these optimization activities that are derived from all these other functions go into the balance sheet direction aspect. So this in terms of best practice, the ALCO charter should capture all these functions, and there needs to be regular, at least monthly, that is the guidance, the standard guidance that has been given by most regulators, that there needs to be at least a monthly ALCO, and the minutes of those ALCO need to be audited and they need to be submitted to the regulator. And given the current scenario, regulators are encouraging banks to have more frequent ALCOs, maybe not with full quorum, but at least with the key functions of constituents of ALCO to review the liquidity situation on a more regular basis. And so in terms of some examples of kind of analysis that ALCO needs to look at, is what is the optimum funding mix? Is the governance infrastructure, does it enable robust stewardship of the balance sheet? So what it means is, whether the analytical capabilities of the bank, how quickly can the ALM team or the risk team answer various questions related to the balance sheet, and whether those capabilities are allowing bank to take quick decisions and guiding the balance sheet in the right direction in the right time. And then looking at LCR and NSFR and trying to optimize the stable funding composition or the HQLA composition, monitoring the encumbrance levels on the liquidity portfolio, and also whether the ICAP methodologies and ILAP methodologies pass the use test, means whether they are too much theoretical or whether they are practical and they're able to drive better decision making within the bank, and many other questions that we have previously touched upon, which I'll not go into again. So that once we set the mandate and the charter and the quorum and how frequently ALCO needs to meet, we come to the risk management process itself. Now, we have earlier said that the mandate of ALCO largely derives from how the board wants to drive the balance sheet, and so that is where the strategy aspect comes in. And from that strategy, at the board level, first of all, there is a risk appetite set that, this is the, level of growth I want to achieve. This is the kind of average credit rating I want to have. This is the kind of liquidity and capital levels I want to maintain as a bank. And therefore, deriving from that, you have various pointers to ALCO in terms of how they need to, manage the balance sheet. And from there, the risk management framework is set up in terms of who will be responsible for developing the policies and methodologies, who will be responsible for regularly running these methodologies to derive the risk measures, and who will be responsible for reviewing these policies on a regular basis and ensure that the policies are being followed as per the set rules, and what kind of systems are in place to ensure that the computes are done in a timely manner. So essentially, all these questions, most banks typically already have some kind of ALM policy and certain org structure. But the key aspect here is in terms of the the central aspect, which is the process to ensure that there is independence between teams that are looking at identification and assessment of the risk, and teams which are developing the models that go into measuring these risks, and another team need to look at the monitoring and reporting aspect. So usually in banks, identification assessment is done by the risk team. Similarly, monitoring and reporting is also done by the risk team. But the measurement aspect, which is independent of either identification or monitoring, is done by a separate balance sheet team or a finance team, which is essentially owner of the data and able to produce most of these computes in an automated format. So there needs to be clear segregation of duties between the people who measure the risk and people who monitor and report on the risk. And then finally, then the business function, which is usually the treasury function, the ALM desk or the funding center within the bank that looks at how to mitigate these risks. And this clearly needs to be independent from the above three functions. So the above three functions come from control functions like risk and finance, while the bottom two come from a team that is responsible for managing this risk on a daily basis, like treasury, funding center, or ALM desk. And optimization is the remit of ALCO committee itself. This is an illustrative example of the typical org structure that or a best or an ideal form of org structure that can be adopted by banks when setting their ALM. So what we usually see is ALCO, either it usually either it could report to board risk management committee or an executive committee. A better alignment for ALCO, I feel, is the executive committee rather than the risk management committee, because ALCO also looks at a number of aspects of strategy and the balance sheet direction, rather than simply reporting on certain risk metrics. And it could actually have a dotted reporting line to the risk management committee as well. And in ALCO, usually the quorum is comprised of the finance group represented by the CFO, the treasury group represented by head of treasury, the risk group represented by CRO, and the heads of various business units who give inputs into the ALM policy in terms of pricing and structuring and understanding the impact of the ALM risk on their businesses. And certain key functions within these CRO, CFO, and treasury officers, which are usually within the risk group, the team which identifies the risk and develops the models, is the market and liquidity risk department. And within the treasury group, who are typically responsible for managing the funding and the gaps and LCR, are either the money market desk or the ALM desk. And within the finance group, usually there is either a ALM team or balance sheet management group or team, which usually looks at the overall strategy, FTP, and reporting or computation of a number of ALCO metrics and performing simulations in terms of future dynamic ALM. So this again, this goes into a bit second level of detail, which I've already covered. So the again, in terms of when we talk about best practices, other than having certain basics, like a robust org structure, some basic processes that are required to regularly measure and report the risks, and having segregation of duties between the business function and the control function. The other most important things is the level of sophistication that the bank is able to achieve in measurement of these risks. So here we see a maturity model of ALM capability of banks, which we have benchmarked. So starting with the basic, you look at just bare minimum analysis in terms of what is the current composition of balance sheet in terms of products, what are the asset yields, how the cost of funds look like, certain basic regulatory, because regulatory ratios are mandatory, so they will be included, like stock ratios. And then this is largely backward looking and basic, if you summarize in 2 words, in that it does not look into the future. It just looks at certain basic regulatory metrics and stock ratios. And there is no agreement between treasury, risk, and finance in terms of the data and the assumptions that go into the computation of these metrics. So from a decision-making perspective, treasury does its own analysis. From a risk reporting perspective, finance and risk look at their own separate data sets to perform regulatory metrics. And then, there is no alignment between the data used for regulatory reporting and the data used for internal decision-making. The second level of sophistication is the static approach, where the measures are static, but there are some analytics in terms of understanding why these metrics are changing and how frequently these ratios are monitored. And at least there is a data governance framework that is set up to ensure that a single source of data used by all departments in doing ALM reporting. And supporting analysis are done on manual basis, in terms of when ALCO asks for a particular product review or impact of certain funding issue or capital instrument or a rollout of a new product. So all these analyses are ad hoc in nature. And the third level is dynamic, where you are not just looking backwards in terms of whether it is LCR or NSFR historically, or the maturity gaps or repricing gaps or funding concentration. All these metrics, you are not just looking at from a historic perspective, but you're also able to project those ratios and metrics into the future using your budget or business plans. So you bring in the business plan, and based on the business plan, you understand, okay, today this is where I am. And based on the growth projected in the business plan, after 1 week, after 1 month, after 6 months, after 12 months, this is how my net interest income is going to change. This is how my LCR is going to change. This is how my NSFR is going to change, so on and so forth. So there is some level of automation required in terms of performing these simulations into the future. And because this is essentially a kind of a scenario analysis, a number of assumptions go into it. So there needs to be sophistication in terms of the behavioral models that are required to project, some behavior into the future in terms of how your current and savings accounts respond to change in market, and how various other behaviors in terms of deposit redemptions and rollovers also behave. And using this, you can project these risk and return metrics into the future. The next level of sophistication is integrated. What if? This is where most banks globally are trying to reach right now. A number of large banks and banks in advanced markets are able to produce some kind of dynamic ALM to look into the future. But what they lack is still an integrated approach. That means a single simulation model or balance sheet model where you apply certain assumptions and project into the future. And it should not only give you the impact on only liquidity or only interest rate risk, but it should be able to tell you at the same time what kind of impact will this have, will this assumption have. So this is not just based on business plan projection. This is a what if. So you should be able to do a number of what if I issue this new product? What if I acquire this new portfolio? What if I scale down or sell down this current portfolio? What if I change my HQLA composition? So there are a number of questions that can be answered through this integrated what if approach. And then the In terms of the capability maturity of ALM, the holy grail is essentially the optimization. And this is something that even large banks, global banks are just starting to look at. And there has been certain progress made in terms of, for example, capital optimization, certain HQLA optimization. But overall, at a balance sheet level, when a particular scenario persists in the market, what is the most ideal direction that the bank needs to take, and how various aspects of that can be managed and optimized, and how NII can be maximized. So this is evolving area that banks are still looking at, and so that is the final stage that most banks are trying to go towards. I think we are probably running out of time, so I'll be a bit quick. So in terms of risk measurement, I'll just quickly highlight on some key metrics that the banks need to start looking at. So essentially, in terms of liquidity risk, we know there is a short-term liquidity, usually measured by stock ratios like LCR, or liquid assets to total liabilities, and so on and so forth, or the maturity mismatch risk in the shorter buckets. And then the structural liquidity, which is essentially looks at the funding profile, funding concentration, or net stable funding ratio, or how the balance sheet transformation is structured in the longer buckets. So probably greater than 1 year, what is the assets to liabilities ratio, so on and so forth. So here we look at the overall life cycle of how liquidity risk needs to be managed. So these are some of the best practices we have recommended to a number of banks, and they have adopted, and they have helped significantly enhancing the liquidity risk management frameworks. Starting with strategic planning, when initially at the board level the strategic plans are made, it is essential to include liquidity along with capital as core aspects of that planning exercise. So if you first decide that this is all we are going to do, and then later realize that neither the capital levels nor the liquidity levels can sustain that kind of growth, so it is useless to do that strategic planning. So therefore, even regulators are now recommending to integrate the risk budgeting exercise with the strategic planning exercise, to ensure at the same time you take a decision, and you want to take a decision, but before taking that decision, you need to be able to understand how these decisions impact your capital and liquidity levels. And then risk framework, it is setting the roles and responsibilities, which we have just seen before, and certain best practices we have already recommended in the setting of risk framework. Liquidity assessment is how do you assess the liquidity of various products on the balance sheet today, and how those risks look like into the future based on how they have behaved in the past. So that is something that we look going forward. And then what are the approaches of performing stress testing? So that I have already touched upon in capability maturity in terms of performing dynamic analysis and integrated approach. And then deriving from the liquidity assessment and stress testing, banks need to look at both normal and stressed conditions. So this is a key important thing, that when setting risk appetite, it's not sufficient to just set risk limits for normal conditions. And now all regulators are requiring banks to set up limits also for stressed conditions. So that means that you need to simulate the balance sheet under stress and understand how low it can go. And based on that, and based on the capability of the bank to borrow during times of stress, they need to set up the limits. So this is an exercise that drives straight from the stress testing exercise. And then historical, how the bank balance sheet has responded to stress historically. And then that leads to the contingency plan, whether, under stress, what kind of actions are available for the bank, and how readily it can apply those actions, what is the time horizon that it takes to apply those actions. So all these aspects need to be covered under contingency funding plan. And essentially, the key operating word is contingency funding plan needs to be a granular document. It's not a policy statement. It needs to clearly prescribe, a time-stamped sequence of events in the case a particular stress is triggered. So first of all, there needs to be a certain, early warning mechanism based on which, ALCO can decide that a stress is imminent. And once this kind of stress is, foreseen, what are the immediate steps in terms of what needs to be the communication strategy of the bank to the regulator, to this, depositors, to other shareholders, and to the market overall? What kind of actions they need to immediately initiate with respect to their liquidity positions and their ability to raise additional funding from the market? And then also understand what kind of outflows they can expect once this stress occurs, and then based on what kind of plan they can adopt and what is the time horizon where they can rebuild their portfolios, to pre-stress levels. So it needs to be a very detailed document. And then finally, deriving from this, the optimization. Now, let me, also, briefly give you an overview of what, interest rate risk is, and then we'll just close by, taking the next possible actions in the interest of time. Now, as you know, based on the new guidelines, the interest rate risk in banking book, Basel has prescribed very specific guidance in terms of how banks need to capture, interest rate risk in the banking book. They've essentially, defined it as a gap risk, which is essentially which derives from the structural mismatches in the repricing profile of assets and liabilities. And then the basis risk, which derives from what are the benchmarks that are used for asset pricing versus liability pricing, and even though both asset and liability may be resetting on the same base on the same time period, but they might be resetting on different benchmarks, and any divergence in the behavior of these benchmarks can lead to risk. So that's basis risk. And then the option risk, which is essentially, all the optionality present, whether explicit or implicit, in terms of prepayment option, redemption option, or just call or put options available on asset and liability products offered to commercial entities. So how these option risk needs to be measured, and how they need to be managed. And then another important new aspect brought in by these regulations is credit spread risk in the banking book. So this is essentially, something that is not that falls somewhere between the transfer pricing that is done by the banks, which is, the funding costs, or the funding rates, which include, your interest rate, base interest rate in the market, and the liquidity premium. And then usually on top of that, the customer credit spread is added to derive the full rate. However, there is certain, market aspect to the credit spreads. So usually, let's say if an institution is traded in the market, and you have, as a bank, you have done your credit assessment. But those credit assessments are done on an annual basis at max. And you only get to view the point in time credit profile of the bank. But because that entity is a traded entity, you can clearly see how the credit profile of the particular company is being viewed in the market, and there is a lot of volatility in how the credit profile changes. And because of this, the credit profile is not constant, but that is not captured under the ECL or capital requirements for credit risk. So that is something new that and because this is derived from market changes in levels of yields that various instruments have. So Basel has decided to include this credit spread risk in banking book on the as part of the IRRBB framework. So and then one key important thing that one needs to understand from this new regulation is that their insistence that banks need to use both income-based measure, which is the net interest income sensitivity, and economic value-based measure, which is the economic value of equity sensitivity. And essentially, the definition is NII sensitivity specifies what is the impact on the net interest income of the bank over a period of horizon. It could be anywhere from one year to 5 years, because of change in the interest rates in the market in certain defined ways. So there is a parallel up and parallel down shock scenarios that have been prescribed by Basel, and banks can adopt additional historical and hypothetical scenarios to assess impact on the net interest income because of these interest rate changes. And on the EV side, essentially the idea is to look at the change in the present value of the balance sheet. So you discount your asset cash flows, discount your liability cash flows, and then look at the net enterprise value. Net of you basically exclude your tier 1 capital elements from this discounting. And then as a ratio of the tier 1 capital, you try to understand what is the change in the valuation, the economic value of the balance sheet under various shock scenarios. Again, here there are 6 shock scenarios prescribed, which are parallel up, parallel down, short rate up, short rate down, and then steepener and flattener. And there are certain differences in how these are treated. In NII, you assume static balance sheet. That means the balance sheet level remains same, while the economic value is a runoff balance sheet that you just look at the remaining runoffs. You don't bring in any new business. And so with that, we'll quickly also look at what is the integrated approach to ALM that we have mentioned earlier. So there is a shift from reactive to a proactive risk framework. So this is the key point that I've been trying to make since the beginning, is that regulators want banks to look forward, understand how their actions right now will impact their profiles in the future. So they don't want banks to react to changes in the market, but be able to understand the impact of various changes going forward at the current point in time, and then be prepared to take any necessary steps to ensure that banks can sustain either through on the liquidity levels or through capital levels, or their sensitivity to changes in interest rate, whatever it may be. So this requires a fundamental shift in how risk management is done. So that requires integrated balance sheet framework, where you look at essentially, it's a virtuous cycle where you look at the current balance sheet. First of all, you need to be able to understand the risk and return performance of various products on the current year. So this is essentially a backward-looking measure. From there, you then understand how the market is going to change, and whether there are going to be any regulatory changes in the next 1 year or 3 years, whatever is the planning horizon. And based on how finance has planned the growth in the balance sheet, you need to be ready to perform simulations to evolve the balance sheet using underlying behavioral models to project how this new business plan is going to impact your net interest income and various other risk metrics. And based on the simulations, you need to take certain decisions in terms of reallocation of capital to different products or different segments or different sectors, and also identify the level of liquidity that is required and the type of instruments that are required, and what kind of product structuring is required, whether you can continue to issue long-term assets, or you need to reduce the tenor, or do you need to make them more repricing. So once these reallocations and review is done, you operationalize the new direction, and then again be able to measure the risk and return performance of each individual segment, product, sector, whatever view that you need to look at, branch, and then you go through that cycle on a regular basis. So this is the integrated balance sheet planning, and this balance sheet evolution and modeling capability is the most important aspect of this, other than the capability to understand the risk and return profile at various slices of the balance sheet. So this is more details. So these are some challenges that banks may face in terms of adopting an integrated BSM. how they can build the analytical capability, whether they are able to report on a timely basis, what level of automation can they achieve, given the data feeds, the quality of data, and then if there are any changes to the regulatory rules during the period. So that summarizes what we wanted to highlight in the short webinar in terms of how banks need to adopt new frameworks and what kind of best practices are available for banks to adopt to enhance their liquidity and interest rate risk management and overall ALCO mandate going forward. So these are some of the points that we've already touched upon, so I'll not go into them again. So it's kind of a summary. Yeah, I think that we can conclude the session. Sorry, I think we've gone overboard. We started 10 minutes late, and yeah.
Let's see if anyone has any question. Although we have exceeded our time, let's take one question if there is anyone has any question.
I think there have been some chats. I'm not sure if there are any questions.
There is no question raised in the chat.
Okay.
All right, if there is no question, James, would you like to speak about SoftFlex and conclude the session?
Yeah, thank you so much, Keda and team from CogNext at Tiva. So it is a great opportunity that we have this webinar together between SoftFlex and CogNext. CogNext is one of our partners that they provide a platform of the regulatory technology solution that we can implement for many types of the solution. For example, ALM, asset liability management, IFRS 9 solution, Basel, and the other product also. And we hope after we finish the webinars, we can have few more opportunity from the customer, and then we can work together to see how the product and solution of the CogNext and Activas, and also SoftFlex is a local partner that will be front of the projects that we work as the business development, sales, marketing, and also the project manager. So that's all from my side. Thank you so much, Keda and team.
Thank you, James. Thank you, Satya, and thank you the entire participants who have joined for this session to make it successful. Thank you, and we are disconnecting. Thanks.